Welcome to Making Sense, an investor education program of the Burlington County Library. I'm Carol Glade, a financial educator, and during this program we'll explore things teenagers can do now to build a solid financial future. Together we'll explore the importance of saving money over time and how compound interest builds wealth. And we'll also look at the time value of money and discuss the importance of having a financial relationship with a bank or a credit union. Managing money will always have its challenge. However, understanding how to manage money you have and to build and protect your funds is key to becoming a smart and a successful investor. So as a young person, it's smart to start early and to start right. Think of money as a tool in your toolbox of life. It helps you to build a good life, both today and for the future. And using your money well throughout your life is similar to using tools to build rather than to destroy something. So just like learning to use tools, everyone needs to learn how to manage money. So watching this video is a great way to start. Having a smart money plan requires saving money for today's living expenses and creating a financial strategy to reach your goals and to get what you want in life is to start early. So a good financial strategy at any age will include having money to spend, having money to save, having money to share, and also to invest. When you're younger, your income will be smaller, but your expenses will also be less than when you're older. So by taking advantage of your youth and starting out right, you can build a great financial future and have wealth if you start now. We all know what spending is, and that's the easy part. It's using money to buy the things we want and need. And saving is having money in reserve for unexpected things, like having to have a new tire on your bike or your car, or having extra money to go to a concert if you want. Having some money to share with others, such as a family member or a friend in need, is also important because it helps you to practice your values and to be the type of person you want to be. Investing is putting money aside for the long term, for 5 to even 30 or 40 years, so you have money to pay for those big things in life, such as an education, a big vacation, to start a business, buy a house, or even for your retirement. There are 3 key principles to keep in mind. The first is that even small amounts of money saved will grow to larger amounts over time. So try to save 10% of everything you earn. When young, your savings has a longer time to grow, and this is called the time value of money. Having an account with a bank or a credit union helps you keep your money safe and helps you build wealth over the long term. So think of your financial future like a soccer game. You want to end up winning and having fun along the way, and you want to reach your goals and come out ahead. Let's explore each of these principles in starting out right. The first principle is that small amounts saved grow over time. A few dollars saved here and there may not seem like a lot, but they do add up over time. So try to save 10% of everything you earn from money from gifts or allowances or jobs. This means that you'd save $1 for every $10 you make. Look for simple ways to save a few dollars every day. For example, you may decide to bring your lunch to school or to work instead of spending $6 for a sandwich. If you save $3 a day, this seems like a small amount of money, but it can end up saving over $3,700 in 4 years. That's saving just $3 a day. If you save more, you will end up saving more money in the long run. So the longer that you save, the more time your money will have to grow. And this is called the time value of money. Let's look at another example. One of the easiest ways and safest ways is to build wealth by saving money in an insured and interest-bearing account. Interest is free money the bank or credit gives you just to have your money on deposit. And the rate of interest that's paid is called the annual percentage yield, or APY, which is noted as a percentage. So for example, an APY of 5% will add about $5 to every $100 you save every year. And this interest grows and adds more money to your savings. This chart shows how a $1,000 deposit will grow in 10 years if you add just $50 a month. If you get a higher rate of interest or a higher APY, your money will even grow faster. So the higher the yield, the faster your money grows if you keep it in an interest-bearing account. You can see that compound interest is your friend. It's free money that you receive for saving, and you even get more free money on top of that free money when it's compounded. So saving money in a jar or in a sock or in your dresser is a good idea, but you don't earn any interest on that. And compound interest, if it's saved in a bank or credit union over time, will help to build your wealth. Being banked or having money with a bank or credit union account is also a sign that you're starting a solid financial future. It shows that you're being mature about your money and show responsibility. So if you receive a paycheck, you can have your money deposited directly to your account, and this will help you save too, because you aren't tempted to spend it. There are many benefits of having a bank or credit union account, so protecting your hard-earned money is most important. Banks and credit unions are insured, and they're safe places to keep your money, and accounts are helpful tools for paying bills and tracking your expenses. So money held in most banks and credit unions is insured by the federal government. This means that if the bank or the credit union encountered a problem, your deposits would be safe. A bank will also help you pay your bills and keep track of what you pay and your expenses, and your money again will grow over time because of earned interest. By having an account, you can have your paycheck deposited directly, so you can get your money and it'll keep it safer. And an account that's also established shows a financial relationship for the future, such as getting a credit card or a loan or even investing in insurance. Plus, you can also avoid using those expensive alternative financial services, such as check cashing places or bill paying services, and keep those fees that you pay these services in your pocket. Banks or credit unions are the main financial service providers in the U.S. today, and it's important to know the difference. A bank is a regulated profit-making business, and money deposited in most banks is insured by the Federal Deposit Insurance Corporation, or the FDIC. There are small, medium-sized, and even large banks, so select the one that has the services that are right for you. A credit union is also a regulated financial institution that's similar to a bank, but the structure is a little different. A credit union is owned by its members, and anyone who makes a deposit is considered a member. So to become a member, you need to have some type of affiliation through employment at a specific company, through a faith-based group, living or working in a community, or through a family member who is already a member of a credit union. Some credit unions, just like banks, are small, and some are large with many locations. And they provide similar services as banks, but the accounts have different titles. So your money is safe because deposits in most credit unions are insured by the federal government also through the National Credit Union Administration, or the NCUA. And the levels of insurance of your money in accounts in credit unions is similar to the same thing as amounts held in banks. So opening an account is not difficult, but you'll need to provide some basic and accessible information, such as your Social Security number or your taxpayer identification number. And a parent may have to confirm the age of a minor child. When you open an account, it's important to understand who actually owns the money. You'll need to determine the type of account you want. So for an example, an individual account means that the person who opens the account owns it singly or by him or herself. A joint account means that it's equally owned by two people. So one person in a joint account can deposit all of the money, and the other person can withdraw all of the money. So it's important to know and trust your account co-owner. Each bank or credit union can provide detailed information, so be sure to ask questions about account ownership before you decide which one is best for you. Bank and credit union accounts basically fall into two types of categories. One is a transfer account and the other is a deposit account. Basically, a transfer account is used to pay bills and to make payments. And the best known type of transfer account is a checking account. A checking account at a credit union is called a share draft account. So some transfer accounts earn interest and some do not. Deposit accounts are generally used for saving money and earn interest or dividends. Saving accounts, share accounts, or certificates of deposits are all types of deposit accounts. If you or your family members are new to banking, you may be able to open a Lifeline basic banking account to get started. These accounts help people who have never been banked open a simple checking account. A basic banking account can be opened with a small deposit, such as $50, and the fees that a bank or credit union can charge are limited. The minimum deposit that must be kept in this account is low, such as even $1. And remember, every bank and credit union must offer a Lifeline or basic banking account, so be sure to ask about it. Like any product or service, it's important to comparison shop for the types of accounts, fees, and minimum deposits that will fit your needs. The rule of 3 suggests that looking at 3 different providers, consumers can access bank and credit union websites or visit the institution to get written materials or to speak with a bank or credit union employee. By having and comparing this information, you can make informed choices and decisions. This chart is an example of how you can shop around and compare various services at 3 banks or credit unions. It's important to find the right account that meets your needs and offers a good APY and low fees so your money will grow. Start out right to build a financial future. Let's review the 3 principles that we've covered. Small amounts of money saved over time will grow due to compound interest, or interest earned on interest. The time value of money means that your money will grow faster if you start early and young. Having a financial relationship with a bank or credit union is important to keeping your money safe and building savings through compound interest. And remember that money in banks and credit unions is insured by the federal government through the FDIC or NCUA. A low-cost Lifeline or basic banking account is a great way to get started with banking and credit union services. And like other consumer purchases, be sure to comparison shop and use the rule of 3 to explore the options offered by these institutions. Learning about money is always important. Thanks for joining me today, and remember to start now to make your money grow. More information on this and other money management topics is available through the Burlington County Library through the Making Sense website at www.makingsense.info. And you can also contact and visit the Burlington County Library for more information. This program was brought to you by the Burlington County Library with funding from the American Library Association and the FINRA Investor Education Foundation. Thanks for joining me.